When we issue stock for a company, we are giving out little pieces of ownership in the company. We are selling ownership in our company. That's what equity financing is. So when we issue stock, there are two types of stock that we can issue, common stock or preferred stock. When we establish our company charter and with the state, and the state tells us how many shares we're authorized to sell, also you'll have something called par or stated value. Let me write those down for you. Par or something called stated value. That most of the time is also associated with your authorized shares. So let's say that you were authorized, 100,000 shares of common stock, but it was 100,000 shares of $10 par common stock. That $10 is an arbitrary figure that has great meaning as far as accounting and bookwork is concerned, but it does not have anything to do with market value. So the par or the stated value, they're very much the same thing, just different names. They don't really have anything to do with the value of the stock. It's just a figure that we give it. Again, it's an arbitrary figure that's given for record-keeping purposes, but it doesn't have anything to do with the actual value. But we will need to know that when we make our entries, when we issue stock. Okay, so it is something that we need to look at and pay attention to. And also it'll change some of the wording with our entries. So just give you a for instance. Let's say that, let's move down a little bit. Let's say that we're going to issue some stock. We're going to issue 10,000 shares of $10 par common stock. Oops, sorry. And we're going to issue that for a total of $180,000 in cash. All right, so let's make the journal entry up for this. Well, we know we're going to get cash. We are getting $180,000, so we're going to debit cash, increase it by $180,000. Why are we getting cash? Well, because we are issuing stock, and stock is ownership in our company. It's a type of equity account. It shows ownership. So at this point in time, our equity section is going to get a little more detail than we've seen before with something like sole proprietorship, because now we have to show all this ownership structure. So we're going to have multiple accounts that we refer to as paid in capital. Someone has to pay us for or give us value of some type. We can exchange other assets. You don't have to pay me cash, but you're going to pay in this capital to get ownership. So we call these accounts paid in capital accounts. So if we're issuing common stock, we're going to record a common stock account as well. But this is where that par or stated value comes in. If there is a par or stated value, that amount is how much goes into the actual stock account itself. So we said it was a $10 par, and that's for 10,000 shares. So that means that we need to increase common stock by $100,000, the par value of the total shares that we have issued. So we increase that equity account, $100,000. Now I don't balance. I still need the rest. The amount that was over the par, the $80,000, that needs to go somewhere as well. It still needs to go into an equity account to show additional paid in capital. Because in total, someone paid us in $180,000 for ownership in our company. So we're going to introduce a new type of account. It's still an equity and it's still a paid in capital account. So we're going to call it, I'll write the full name out for you. It's going to take me more than just the space. Paid in capital in excess of par common. I know, really long account name, right? Yes, it is. But that's where the difference over the par value would go. Paid in capital in excess of par. Okay? What if instead, let's do another issue. Let's say that we issued 8,000 shares, but this time it was $50 par preferred stock. And let's say we issued it for $500,000 cash. Okay, so we're getting cash again, and we are getting a total of $500,000. So we're going to debit cash, increase it, $500,000. Now we're not issuing common stock, we're issuing preferred stock. So we're going to have a preferred stock account. Again, equity account, paid in capital, and as long as there is a par or stated value, that's the amount that's recorded here in the preferred. And I put too many of one and not enough of the other. Let me rephrase here. Preferred, there we go. So, this was $50 par and it was for 8,000 shares. So that means the total that needs to go into the preferred stock account is $400,000. So we're going to credit that account, increase it by $400,000. The difference goes into, this should be $100,000 credit difference. That increases another paid in capital account. So this time, I'm going to shortcut. It would still be paid in capital in excess of par, but this time it's for preferred. That's the only difference here. Okay, the par value, if there is one, goes in the stock account. The rest that's over that would go into a matching paid in capital account, paid in capital in excess of par, in excess of stated value. So the only difference, if you had par or stated value, would that be instead of saying paid in capital in excess of par, you would have said paid in capital in excess of stated value. It's just a terminology difference. How they function is the same. Now let me give you another for instance. What if we issued stock, but this time I didn't issue it for cash. I issued it for land. So I had someone and I wanted to purchase some land, and I said, hey, how about if we trade? I'll give you some stock in my company, and you can give me some land, and you work out a deal. When you exchange other assets other than cash, you have to look for a market value. So either whichever one is the best known market value, either your stock that you're giving up or the asset that you're receiving, whichever is the best known or the most reliable value, that's the one that you'll use. So let's say that we issued some stock. Let's say we issued 2,000 shares of $1 par common for land. And let's say that the land value was $50,000. So let's record this. Well, we got land. So we're going to increase or debit the land account for $50,000. Market value of the land. This is our best market value that we knew. Now we issued stock and it was common stock. So we're going to also increase the common stock account. And it has a par. So it's $1 par for 2,000 shares. So that's $2,000 that we're going to increase or credit the common stock account. Now we don't balance. And that's because we exchanged this for a value higher than the par, and that's fine. So the remainder, that $48,000, is going to be credited and increase that additional paid in capital account. So again, I'm going to shortcut a little bit because of space. So paid in capital in excess of par common. There we go. Recorded the issue of stock for land. What if you don't have par or a stated value? All right, so let's say that we've issued some stock. We issued 1,000 shares of no par or no stated value common for $5,000. All right, so we got cash. We got $5,000. But I don't have any par. So if you don't have par or stated value, then all of that goes to the stock account. So all of that is going to go into common stock $5,000.